Hello, welcome to our session on regression analysis. Today, we will try to understand how regression analysis can help to data-driven decision making in the hospitality. Also, it can be used in forecasting. Okay. Uh, let's start with some basics. Regression analysis is essentially a statistical method, right? It's our go-to tool when we want to understand the relationship between things. Imagine you are curious about how sales are influenced by, let's say, advertising dollars or how ticket prices affect airline revenue. Regression helps us model these relationships, providing a way to predict future outcomes based on these insights. It's useful tool when we have a dependent or outcome variable and one or more independent or predictable variables. So you have a dependent variables and you are trying to use one or more independent variables to understand this relationship. By the way, if you are seeing some interesting weird writings in the images, I just tried to use the new AI tools to generate these pictures, and I guess they have problem with the text. But I just want to do it to make it more enjoyable slides. Anyway, now why should we care about regression revenue management? The applications are many. In our research, especially I use many variation of regression analysis. With regression, for example, we can forecast demand, determine the most profitable price, and pinpoint the key factors that drive the revenue. Whether it's forecasting hotel room bookings or analyzing the seasonality of sales, regression analysis help us make informed strategic decisions that directly impact the bottom line. Now, there are several types of regression analysis, each serving different purposes. At its simplest, linear regression deals with the relationship between two variables. When we add more variables into the mix, we step into what we call the multiple regression, which allow us to explore more complex relationships. While there are other types like logistic regression, focusing on these two forms provides a solid foundation for understanding the basics. Before diving into regression analysis, it's crucial to understand, grasp the underlying assumptions. For the sake of time, and I am assuming you already are familiar with this from your statistics course, I won't go into detail. However, if you are planning to use regression extensively, it is extremely important to understand these. If we are not following the assumptions, the result most likely be false. First, we assume a linear relationship between our variables. We also presume that each data point acts independently from the others, like they are independent. Additionally, the variance of our error terms should remain constant, and these errors ought to be follow normal distribution. These are all important. So keeping this assumption in check ensures that the reliability and validity of our analysis. Usually after the fitting our model, it's imperative not to take a step back and rest. We must verify that assumptions underlying our analysis hold true, right? I mean, there are many different diagnostic tools like residual plots and like there's a statistical approach like Durbin Watson statistics for the time series, independence of errors like in the normality. We have to look at the both graphically and statistically. But in the end, think of it as a quality control in manufacturing, right? We are ensuring our product, the regression model, meets the highest standards before it goes to market. So that's why the assumptions are important. I mean, this is just giving you some ideas. There are multiple steps, like for example, residual analysis, diagnostic plus, etc. And later, of course, if we find some issues, we need to learn how to address those issues, right? At the heart of simple linear regression lies a straightforward equation. Y, which is the dependent variable, equals beta 0 plus beta 1 times x plus some error term. Here is y is what we are trying to predict, and x is our predictor. The betas represent the coefficients, that's the model we estimate, telling us about the direction and strength of the relationship. The error term accounts for the variance not explained by our model. Now, we're going to talk about this, so you shouldn't worry about it. I'll give you a real example in the Excel. So how do we find the values for our coefficient? Like enter the least square model, for example, the OLS. This approach minimizes the differences between our observed values and the values predicted by our model. The coefficient it produces help us to quantify the relationship between our dependent and independent variables. In a sense, they tell us how much we expect y to change with one unit change in x. So offering insights into dynamics at play. We will give an example, like I said, in Excel in a minute. Once we build our model, the next step is to evaluate how well it fits our data. There are many other factors, but these are the most important ones. The first one is the R squared value, or the adjusted R square. It gives that's represent the proportion of variance in our dependent variable that explained by the independent variables. So what we are saying is, higher the R square or adjusted R square, higher the or better we explain dependent variable by the independent variables. And the significance of f-test is basically says is if our model improvements are genuinely capturing the additional information, or basically is overall model is significant or not, so it is acceptable or not. While regression analysis is a powerful tool, it is not without its limitations. Factors like multicollinearity, where independent variables are highly correlated, can skew our coefficient and make them unreliable. Overfitting is another concern, where our model captures the noise in our data rather than underlying trend, compromising its predictive power on data. And to navigate these pitfalls, a deep understanding of our data and the context in which we are applying regression is very important. However, like I said before, I just want to give you this initial what is the regression talk. But we have to understand this. This is a revenue management course, and given the time also, because we need whole semester if you want to truly learn them, we will assume you have some kind of background from statistics, and also for sake of our Excel files, we will assume that we met all the assumptions are met, and there are no issues with the data. Okay, so let us go to Excel and run some basic regression analysis. Okay, where's my Excel? Now let's start with the basic regression. Now, I want you to understand one thing. In this case, we are using a simple regression, and sometimes it's been used for forecasting. I don't really recommend it, but just for the sake of teaching it, I want you to understand how it works. So that's what we are going to do. How it works? Actually, let's create, as usual, some kind of chart. So you will see what does it look like. Okay. Now let's create let's analyze using the regression analysis. From the data, we go to data analysis, you select the regression. Okay, of course I did this before, but for the sake of simplicity, for the Y range, we are going to select our data. Okay. For the X range, we are going to select the period. Okay, we also click on the labels because we have a labels here. And for output range, I just randomly selected some area here. When we say OK, it's calculated basically. You can see output here. There are several things I want you to look at. First thing is R square, right? So it actually is considering what we have. This is important. One thing I want you to mention, because this is a simple regression, because we need the one independent variables, we are trying to look at the overall occupancy, or actually I don't remember what was if this data was occupancy, but our data was predicted by the period. So idea here, when the period increases, the data points also increases. Okay, so if we are assuming once again that is a correct, so we can do forecasting using several things. Actually, let me explain the output first. First is the R square, right? Is 38%. So what we are trying to say here is, using this regression analysis, results could explain 38% of the variation in our data. I mean, considering the randomness of the data, actually, this is a very good result. Second things we want to look is the significance of F. Actually, let's make these values number with the 4 digits, so it's like better. Now, actually, 0% means is excellent significance, so there is no issues with the overall model's fitness. So this model fit well, and we also need to look at the intercept and period. Both has also significant. Now, how are we going to calculate the forecast then? We go here, we enter the equal, we say intercept plus period, or the, when I say period, actually that's the it says period, but it is the independent variable outcome times period. That's what it gives, right? So if we follow this all the way down, oh, of course, you have to, you see, do you remember I was telling you the importance of locking the values? That's what is important, because we forgot the lock, this one and this one. Now, if you can see, the data fits. This is our forecasted data. Basically, because of data, our data increases, this increases as well. This is, like I said, in this case is not very useful. I just want to show you the regression outcome. But let's look at the multiple regression. That might give you a better idea. Now, this is data from a hotel and has multiple things in it. What is it? First, occupancy rate, right? So we collected the occupancy rate, average daily rate, seasonality, marketing spends, and some kind of events. Now, you already know what the occupancy rate and average daily rate is. Seasonality is kind of number indicator, shows if it's the higher the number, basically, higher the season, in a sense. And the marketing spend is how much you spend for the marketing, and events, as the name indicates, if there is a certain events going on in that area. Now, if you do the data analysis once again, if you go to regression, of course, we need to delete this. Now, what was this? This is a Y, right? This is a dependent variable. What is our dependent variable? Is the occupancy rate. Cover all the way. Okay. Now, we got the dependent variable. Let's go to independent variable. What is the independent variable now? Independent variable is actually multiple things. Like there are 4 different independent variables we argue that might affect dependent variable. We already have a labels. Instead of output range, I'm going to put it actually a little bit down. The reason I'm going to explain in a minute. Let's put it here somewhere. And we say okay. Now let's look at quickly. Considering this is a multiple regression, actually this is a very, very high value for 70%. I mean, if I were doing a research, most likely I'm going to investigate if there is a multicollinearity or some other issues we talked in the earlier, because this is kind of high in my opinion. But anyway, for the sake of this, we said that the assumptions are met, there is no issues, so we will accept that. So this data we did, we analyzed, all these 4 independent variables can explain 70% of the variation in the dependent variable. Second things, actually let's turn this also once again to numbers so you can understand better. So all significance for the overall model is perfect. All the p-values are good. So if it's the idea is here this, if p-value, there is no like strict rule by the way, but usually accepted rule is if the value is less than 0.05, that considered as a good value for both models and each of the independent variables. If it's higher than 0.05, we say that, for example, let us assume that average daily rate was higher than 0.05. We say that average daily rate is not significant enough to affect the dependent variable. So for the sake of simplicity, let's do 1/1/2024. We want to find actually we need to find how this is going to change for some. Let's make up some numbers. Okay, give me a second. I did some earlier. These are some made up numbers. Okay, so what we are saying here is if average daily rate is 152.3, seasonality is kind of considered high, 70.65. You spent about $865 for the marketing events, and there is some kind of events going on. What is the occupancy rate is going to be? That's the things we are trying to consider. We say equal, we got the intercept. Okay, let's hit the 4. Plus, what we have? Average daily rate times coefficient of it. Plus, what else we have? Seasonality times seasonality coefficient, F4, plus marketing spending times marketing coefficient, plus is there any event going on, right? Times events coefficient. If we hit this, we expect the 92.5% occupancy rate. Let me explain a little bit more in this. Logically, right? Considering this the real regression, let's look at these values. Average daily rate is, give me a second. Average daily rate is negative and affect 0.3. Basically, there is a if the average daily rate changes $1, the occupancy rate drops 2.3%. So what does that mean? If you think about it, it makes sense, right? The higher the average daily rate, there will be less occupancy. And what about the seasonality? If you remember, seasonality was a number that higher the number is better season for the people to come to hotels. So basically it's indicative of higher the number is better for occupancy. So as the name, as the coefficient shows that positive number, which means the higher the seasonality, higher the occupancy rate is going to be. The one thing I'm surprised is the marketing spend, because its value is very, very low. So if you look at it, one, two, three, so per $1,000 spent is about 9% increase. Maybe it's not too bad, but there is also a possibility that marketing spend, because this is a daily data, may be affecting in the future, not in that date. So, but like I said, because of the, we don't want to get into too much detail. We don't want to get into lagged independent variables. Lagged independent variables means like you spend something, but you see the effects in, let's say, in 1 week. And events, as expected, the highest one, the effect, right? Because if there is an event, is automatically increases occupancy rate. So this is the basics of the regression analysis. So I hope you enjoyed. Thank you.